Hey, so I'm going to give a quick lecture on ASC 606, Step 1, identifying a contract. And so this tends to confuse a lot of different people because it contains a lot of complex elements that seem self-explanatory but can be kind of tricky. Like the question of, does a contract exist? This seems pretty silly, right? Because if you have a contract and it's signed by both parties, you think it would exist, but from an accounting perspective, that's not necessarily true. You only have a contract if each party has approved that contract and is also committed to perform that contract. Each can identify each other's parties' rights and obligations. Each can identify the payment terms for the contract, and the contract actually has commercial substance and is probable will collect on that contract substantially all the consideration. So let me go through all of those pieces, and then also this concept of contract combination, which can be a little confusing as well. So the concept of, have we approved and are committed to perform each contract? What that really means is, if I'm signing a contract, or you have a customer that's signing a contract with you, is that contract real? Like, does that customer actually have the ability to pay you under that contract? And are they committed to pay you? And do you actually have the ability to perform what has been requested? So an example is, I'm one person. I don't have an accounting firm. And if someone signed, a work order with me, or a statement of work, and they had asked for me to supply 20 people for $1 million over the next year or over the next few months, and I agreed to that contract, I couldn't really recognize revenue on that contract as I don't have the resources to provide, right? Like that, maybe I'm gonna try to hustle and get those resources in the long run, but currently I don't have those resources, and because I don't, that really doesn't mean that I'm committed to perform under this contract. It might mean I'm entering it into it in bad faith, is what we'd call that. Also, if the contract is too vague, if a customer asks, let's say if I'm talking about accounting services, you would talk about products. If a customer said, I just want 100 things, 100 of your things, or 100, I want to have you work on a project. But that project isn't specified, or the things aren't specified, and the prices aren't specified, or it's too abstract, or results in future negotiations, then we ultimately aren't going to be able to recognize that as a contract. You have to be able to identify specifically the rights and obligations of each party. So I need to know that, hey, if you're signing that contract, I'm going to perform these services, or the customer is going to perform the services. In exchange, you're going to get specific payment terms. And so that's the next step, is identifying these payment terms. And so by payment terms, we need to know how much you're going to pay. Is it prepaid? Is it net 30? Is it going to be paid over a longer period of time? Or is it on the back end? And does the customer ultimately have the ability to make those payments? And so there should be some kind of collection assessment done on day one, that we're not signing up with a customer that just absolutely can't afford this contract. So for example, if I promise to purchase, $1 billion commercial building, so I'm the customer purchasing that $1 billion commercial building, that's not something that I could actually, afford. I wish I could, but it's not something I can actually afford, $1 billion commercial building. If, let's say, I'm making $100,000 a year, it's $1 billion. If they try to sell that to me, they shouldn't be able to recognize revenue under that sale, because I'm so far from being able to pay even a small portion of that. And the hurdle is actually higher. You need to actually pay for substantially all of the commercial building, or all of the product or services. So if we're signing up large contracts, we need to make sure we're doing proper credit checks and credit assessments. And then lastly, you want to make sure there's actually commercial substance to the transaction. So this can get tricky is what we'd say, like friends, friend transaction, best friend transaction. So if I call up my purchaser and say, hey, listen, if you can sell me $1 million of services, I'll sell you back $1 million of my services. And that way we both can recognize $1 million of revenue. We're just not supposed to do that from an accounting perspective. That's essentially overstating your revenue. That's perpetuating this concept of fraud. So you don't want to be in a situation where you don't have commercial substance, the underlying transaction. Or another way to think of this is, do both parties actually need those services? Like if you're hiring my accounting services, but you don't need it, and then I'm going to hire your software services, but I'm actually not using the software, neither party should be able to recognize revenue on that. And in that case, a contract doesn't exist. And so if a contract doesn't exist, what that means is that you cannot recognize revenue until you subsequently recognize a contract. And so that would mean you would defer a large portion of your revenue until a contract exists. And that wouldn't be even allowed to be called deferred revenue. So let's say you're collecting cash against a contract that doesn't exist. You would have to hold that as a customer deposit. You wouldn't be able to recognize that as revenue immediately. The other concept here is contract combination. So if you have two contracts that are negotiated in near proximity or have intermingling of terms, you need to make sure that you assess them as combined for the rest of your assessments under ASC 606, including your performance obligation considerations and the transaction price of your contract. And the reason that ASC 606 demands this is because you need to make sure that you're allocating appropriately to the underlying performance obligations. So where this could get tricky is, like, if I execute a contract in Q4, and in Q4 it's very favorable to the seller, but then in Q1 I'm going to give a bunch of free products and services, which isn't favorable to the seller, we should theoretically allocate some of the transaction price from the selling the products we're selling at list price to the underlying free performance obligations, which would defer some of the revenue and wouldn't look as favorable to the seller. And so this is a way that we get ahead of kind of like tricking the guidance, right? So this is just step one in a nutshell for ASC 606. I'm going to give a few lectures on the rest of the steps and things to watch out for. You all let me know if it's helpful. If you like this content, please subscribe, click the checkbox below, and let me know if there's anything else I can do to help. Thank you. Bye-bye.